Haverty Furniture just dropped its third quarter numbers, and boy, the market reaction was something to watch. The stock shot up over 15% at first on what looked like a solid beat, but then it gave back about half of those gains by the end of the day. So, what's going on? What did investors see that made them both excited and, well, a little nervous? We're going to break it all down, the return to growth and the price they're paying to get there. Okay, so let's jump right in. Here's the game plan. We'll start with the headline numbers, then dig into what's really driving this new growth and what it's costing them. After that, we'll put it all into context with what's happening in the broader industry, and then we'll wrap up with our take on what to watch for next quarter. All right, first up, let's look at the numbers that got everyone so excited initially. I mean, after a pretty tough stretch, Haverty is officially growing again, and they definitely delivered a nice upside surprise to Wall Street. So revenue for the third quarter came in at a strong $194.5 million. And get this, that's a 10.6% increase compared to the same time last year. For investors, that is a huge and very welcome acceleration. And then on the bottom line, GAAP earnings per share landed at 28 cents. So that really completes the picture of a clear beat. And this slide really just lays it all out. Haverty didn't just squeak by the consensus estimates. They cleared the revenue number by over $11 million and beat on earnings by about 17%. That's a solid win on both the top and bottom lines, no question about it. Okay, so here's the million-dollar question. How did they pull off this growth? The story here isn't just about selling more furniture. It's about a very deliberate choice to spend money to make money. And that, right there, is probably what cooled off the market's initial celebration. So management pointed to a few key things. They had a fantastic Labor Day event. Written sales jumped almost 14%. They actually got more people into the stores. That's positive traffic. The average ticket size was up. And their high-margin design business, it now makes up over a third of their sales. And here's the kicker. This was their first quarter with positive comps in several years. That's a big deal. Which brings us to the real tension in this whole story. The growth is absolutely real, but it wasn't free. And this is the trade-off that investors were trying to wrap their heads around all day. Now, this is where it gets super interesting. Take a look at this. This is what we call a lack of operating leverage. Their spending, the selling, general, and admin expenses, or SG&A, it actually grew faster than their revenue. You can see it right there. The bar on the right at 11.3% is just a little bit taller than the revenue growth bar on the left. For anyone who cares about profit margins, that's usually a red flag.
But management has a story for this. The CEO, Steve Burdette, he basically said on the call, look, we pulled back way too hard on marketing before. So this quarter's $2.8 million bump in marketing spend, which even included bringing back direct mail, wasn't them losing control of costs. It was a strategic move to get the business fired up again.
Okay, so let's zoom out for a second and look at the bigger picture, because no company operates in a vacuum, right? And Haverty is trying to navigate some pretty significant challenges that are affecting the whole industry. Their big focus on the design business, that's really a key part of their defense. Making up over a third of sales, this is a higher touch, higher ticket service. It helps protect their margins and really sets them apart from the competition, which is just crucial when shoppers are being careful with their money. And speaking of headwinds, they're not just sitting around waiting for things to happen. They're actively dealing with new tariffs on furniture coming from key countries. To protect their bottom line, they've already started raising prices strategically back in October, basically trying to pass those costs along and defend their profit margin goals. And you know, this context is so important. Even with this good quarter, look at the stock's performance over the last year. It has just dramatically underperformed the broader retail sector. This pressure really highlights how critical it is for management's turnaround plan to actually work. Investors need to see that this isn't just a one-time thing. So where does that leave us? The top line is healing, which is great, but the cost to run the business is also going up. So here's our forward-looking view on Haverty and what we'll be watching like a hawk heading into the next earnings call. We're looking at 4 key things. First, their holiday performance. That's going to tell us a lot. Second, they're actually starting to grow their store count again in 2026, so we'll be looking for early signs there. Third, can they make those tariff-related price hikes stick without scaring off customers? And finally, and honestly, this is the big one, can they get that SG&A leverage? The whole bull case for this stock really hangs on whether their sales growth can finally start to outrun their expense growth.
When you balance the impressive return to growth against the very real and very necessary costs to get there, we're kicking off our coverage with a market perform rating. The strategy makes sense, we get it, but the risk in executing it perfectly keeps us on the sidelines for now. It's a classic wait and see. Now, for those of you looking for a more specific trade idea, you might consider what's called a pair trade. You'd go long on Haverty and at the same time short a different furniture retailer, one that's maybe more in debt or less unique. The whole idea is that Haverty's debt-free balance sheet gives them the power to invest in marketing and new stores, letting them grab market share while their weaker rivals have to cut back. And as always, this is not financial advice.